We are joined by Bob Iaccino. He's the Chief Market Strategist at Path Trading Partners. Bob, thanks for being with us. We've been talking a lot about earnings, but we know that the market's been keeping a really close eye on those bond yields. Why are we seeing such a severe, especially yesterday? We were here about noon. We saw the yields creeping up, and there wasn't really anything going on. And then, boy, did we see that selling hit in the afternoon. What is it that investors are so worried about?
Well, Maggie, I think it's a combination of things. Number one, you mentioned the yield, and that became sort of a self-fulfilling prophecy. I personally don't believe that 3% is this sort of Armageddon for the 3-decade-long bull market in bonds. It's definitely a tick higher, but we've done this before. We approached 3%, and then within about 6 months, we've been back below 2% on some of the short-end yields. So it's not as big of a deal. I think part of the problem we had yesterday was, in addition to crossing that yield, that's when we had the press conference with President Trump and President Macron, where it seemed like the Iranian nuclear deal was in jeopardy. That could boost oil prices. That could do all kinds of things to the global economy, the sort of unseen consequences of those kind of actions. So I think it was a combination of those two things. You talked about Boeing a second ago. Boeing adding about 80 points to the Dow right now, and the Dow's only up about 35. So the pressure is definitely still lower on these equities, even though the earnings have been fantastic.
Yeah, and as we're talking, Bob, it's actually moved into negative territory and now down 15. So we are, right away just sliding off. I noticed the dollar strengthening as well. You know, we always hear companies blaming currencies when it's convenient, but are you guys watching that? How important is that?
We are, because it's a confirmation for the yield move. We've seen the dollar move lower and yields move higher in the past. That's not the typical relationship. Now we're seeing the typical relationship. So that's sort of a confirmation, in the same way that when you see the VIX spike, you want to see gold spike. If you're seeing those two move in tandem, then one of the two is trading incorrectly. Right now, we're seeing the prediction of higher yields not only come true in the yields, but respond in the correlating market, and the dollar's the main one.
Bob, when we're looking at these yields, though, historically, they're still very low. You know, even if we're seeing high yields, is that going to spark this big rotation out of equities into bonds?
I don't think so, personally. I don't think 3% is that level. You start to get above 3.50, 4%. Now you're challenging some of the yields you get on equities, especially some of the higher-paying, stronger dividend stocks that are yielding 4, 5, 6%. It's still not a competition when you add in the potential equity growth we could get third and fourth quarter. The thing that worries me the most is bond yields above 3% and us hitting peak earnings, which may be happening. We've got 18.3% so far, blended earnings growth rate as of Friday. The last time we were this high, 2011 first quarter. May 1st, we hit the high in stocks in 2011, and then we saw a 20.5% drop because that was peak earnings. So that's what worries me. It's the combination, again, of the two things. Any one factor isn't really a concern, in my opinion.
Yeah, that's a great point, Bob, and that's why we are listening so closely to what those CEOs said in Caterpillar, suggesting that maybe they're peaking. Another one of the reasons we saw that big sell-off. Bob Iaccino, thank you so much. We'll let you get back to work. Appreciate it.
Thank you, Maggie.